Welcome to our 20,252,026 Market and Technology Outlook. Today, we're navigating the inherent tension between the immense promise of innovation and the persistent structural pressures that shape our economic landscape. As you can see from this visual, we're balancing exciting growth opportunities like AI/ML, projected to grow by 24%, and sustainable tech, which we expect to see an 18% increase. However, these promising trends are counterbalanced by significant pressures, including supply chain risks, which could see a 15% downturn, and geopolitical tensions, potentially leading to a 22% negative impact. It's a dynamic interplay that demands our careful attention. Let's dive into our executive summary, which we're calling the comfortably uncomfortable market. On the rally or promise side, the economy appears bent but not broken, seemingly achieving a soft landing. We're witnessing an everything rally, with gold significantly outperforming at 26% and emerging markets up 2%, both beating cash. Deal-making is also robust, with global deal value hitting an impressive $3.8 trillion in 2025, marking a 35% year-over-year increase. However, on the friction or pressure side, inflation remains sticky. The five-year inflation swap rate consistently stays above the 2015 to 2019 average. We're also experiencing a regime shift, moving from a period of low rates to one characterized by two-way risks and significant policy uncertainty. This creates a market that is both resilient and demands caution. Turning our attention to U.S. equities, we observe what we call the concentration dilemma. There's a striking performance gap between the Magnificent Seven and the rest of the market. The Mag 7 delivered a year-to-date return of 27.5%, driving approximately 53.7% of total 2024 returns for the S&P 500, which itself saw a 17.5% return. This highlights a significant concentration risk. Looking ahead to 2025, we project standout performances from companies like Alphabet, potentially up 65.8%, Nvidia, with an estimated 40.9% gain, and Tesla, projected to rise by 20.2%. Next, let's examine the AI trade-off: the promise of income versus the pressure of capital expenditure. As you can see, companies like Microsoft are projected to have substantial capex, around $80 billion, and Meta at $65 billion in 2025. This massive investment is happening while Nvidia holds a dominant 86% of the AI data center revenue market share, compared to Intel's 6%. The critical tension here is whether the return on investment can truly keep pace with this enormous infrastructure spend. It's a key question for profitability and sustainability in the AI sector. Equity volatility, we believe, is acting like a coiled spring. While current volatility remains muted, powerful structural drivers are steadily building tension beneath the surface. These include political concentration, particularly single-party control in Washington, rate sensitivity, with the 10-year Treasury yield hovering between 4.5% and 5%, and significant geopolitical factors, such as a bipolar world order and increasing climate shocks. The current low VIX might imply stability, but the negative correlation between bonds and equities intensifies significantly when yields reach that 5% mark. This suggests that while calm now, the market is highly compressed and ready to react. Moving on to crypto assets, we're seeing what we term the maturity narrative. Our volatility regression chart shows a significant trend. Bitcoin's volatility is now less than that of 33 S&P 500 stocks, including Netflix, marking a clear crossover event. This reduced volatility, coupled with what we identify as seller exhaustion, historically precedes price appreciation. This key insight suggests that the low realized volatility we're observing could be a precursor to future price gains, indicating a maturation of the asset class. However, with maturity comes new considerations, specifically, the blockchain risks posed by the quantum threat, or Q-Day. We project that by 2030, Shor's algorithm could break ECDSA cryptography, which is currently fundamental to Bitcoin's security. This could put 1.7 million fiat zombie BTC at risk, including Satoshi's coins stored in vulnerable P2PK addresses. While this is a serious threat, mitigation strategies are in development, with Ethereum and Bitcoin planning post-quantum cryptography upgrades. These implementations, however, could take 5 to 10 years. Let's shift our focus to the data economy, which is rapidly evolving from a mere byproduct to a core product. We project substantial growth, with data as a service, or DaaS, seeing a compound annual growth rate of approximately 25.92%. This expansion is driven by key areas like edge computing and the increasing need for AI/ML model training. What was once secondary is now becoming a central pillar of economic activity, demonstrating immense market potential. This brings us to a strategic shift. Are we witnessing the death of the data moat? We believe that sheer volume is no longer a sufficient defense. Integration is. The old moat of hoarding raw data is becoming commoditized, especially with advances like GPT-4. We're moving towards a process moat, where proprietary data combined with agentic AI workflows creates true competitive advantage. As we say, your proprietary dataset stops being a castle wall and starts looking like a speed bump if not operationalized. This marks a fundamental change in how data creates value. Alongside these technological shifts, regulatory pressure is mounting, particularly with the EU Data Act, which aims to attack vendor lock-in by 2027. This initiative introduces several key mandates. First, users must have access to IoT data generated by connected products. Second, products must be designed for data accessibility, and by January 2027, there will be a total ban on cloud switching charges. The strategic impact of this is profound. Users will be able to force manufacturers to share data with third parties, even direct competitors, fundamentally altering market dynamics and data ownership. Now, let's explore alternative assets, specifically making a strong case for real estate. In our 3x3 comparison matrix, we evaluate intrinsic value, volatility, and accessibility across crypto, stocks, and real estate. While crypto lacks intrinsic value and has high volatility, and stocks offer performance tied to sentiment, real estate stands out with high intrinsic value due to its utility and shelter, combined with low volatility. Crucially, innovation in fractional ownership models is democratizing this asset class, allowing entry for less than $100. This makes real estate, the only asset class with tangible utility, highly accessible to a much broader investor base. Given the dynamic market conditions, a robust investment strategy must focus on defending the portfolio. This involves several key components, as illustrated by our tail risk payoff diagram. We advocate for tail risk hedging, which protects against significant drawdowns and prevents forced selling during 10 to 15% market corrections, often for an annual cost of less than 1%. Additionally, effective tax management through systematically harvesting losses and intelligent diversification by rebalancing to prevent portfolio drift are crucial for maintaining long-term stability and optimizing returns. Looking ahead to our 2026 outlook, we anticipate building on strength. Global deal value, encompassing M&A and IPOs, is projected to reach $3.8 trillion, making 2026 potentially the second-best year ever for deal activity. Consensus themes include moderate gains for the S&P 500, around 12%, a broadening of market leadership beyond just the Magnificent Seven, and a continued soft landing for the economy despite any tariff noise. These indicators paint a positive, yet cautiously optimistic, picture for the coming year. In summary, let's synthesize our strategic outlook for 2026 by looking at both the promise and the pressures. On the promise side, we see AI moving from pure capital expenditure to more agentic workflows, data monetization growing robustly at a 26% CAGR, and Bitcoin maturing into a lower volatility asset. However, pressure points include structural volatility from geopolitics and sustained 5% yields, regulatory headwinds like the EU Data Act, and existential tech threats such as the quantum Q-Day. The imperative for 2026 is to get comfortably uncomfortable. This means staying invested in growth opportunities while actively hedging against those critical tail risks. It's about balance and proactive management. Thank you. Here are the sources we consulted for this presentation, including J.P. Morgan, Morgan Stanley, and Fidelity Digital Assets, among others. Please note, this presentation is for informational purposes only and does not constitute investment advice. Past performance, including that of the Magnificent Seven, is not indicative of future results. Views are subject to change based on market conditions, and this is not an offer to sell or a solicitation of an offer to buy any securities.